Time now for the day's business news, and Brian Quinn is with me in studio. Brian, we're going to start with a major sell-off on the world markets.
Right, somewhat ironically, it was a positive jobs report in the U.S. It set off that major downturn in the markets as increasing jobs and rising wages point to quickening inflation. The question now is this just an overdue correction or the start of a longer pullback? Georgina Robertson reports.
On Friday, US equities markets were hammered by their biggest sell-off in 2 years, with the Dow Jones Industrial Average losing 665 points, its largest drop since 2008. But with 9 consecutive weeks of gains behind it and a record year, many analysts say that kind of turnaround is to be expected.
This should be normal behavior inside of a market. It's actually healthy and productive to have sell-offs like this at times, no matter what starts them.
Spooking investors are 2 major factors. The first, the most recent US jobs report. With better-than-expected employment figures, coupled with average hourly earnings rising at a rate of 2.9%, this report raises the spectre of faster inflation. The second, bond yields. US 10-year Treasury bonds hit a 4-year peak of 2.86% on Friday, showing a reluctance to engage with the risks of a volatile equities market. They're considered an important yardstick for market confidence.
We've not seen rates on the 10-year this high in 4 years. So that's indicating or telegraphing to the equity market that higher rates generally means lower equity prices, and that's where you're seeing traders get ahead of that.
Market watchers are expecting the US Federal Reserve to raise interest rates as many as 4 times over 2018, which will make borrowing more expensive for corporate America, potentially ending the recent market rallies.
All of that, I imagine, Brian, having a pretty negative impact on the markets?
That's right. European indexes following Wall Street's lead, opening sharply lower Monday. London's FTSE 100 down 1.1%. The CAC 40 here in Paris off by 0.9% at the open. German markets also hit by political worries as talks to form a coalition government Sunday failed to result in a deal. The Frankfurt DAX opening down 0.9% as well. Asian indexes also taking a tumble Monday. Tokyo's Nikkei closing down over 2.5%. Kospi in South Korea down over 1.3%. Hong Kong's Hang Seng Index down around 0.2%. China's Shanghai Composite, the one bright spot, clawing its way back up from earlier losses to gain around 0.75% as the country's service sector sees its fastest growth in 6 years. Well, time to take a look at some more of today's top business headlines now. The U.S. Federal Reserve gets its new chair Monday. Jerome Powell will be officially sworn in Washington after taking over from outgoing chair Janet Yellen on Saturday. The 65-year-old Powell is the wealthiest chair for the U.S. Central Bank in 70 years and the first non-economist to hold the post in the past 4 decades. A French union has called for labor actions against Carrefour beginning Monday. The French retail giant last week announced it would be cutting some 2,400 jobs in France, along with the closure or sale of 273 stores under its Dia subsidiary. If the Dia stores fail to find a buyer, an additional 2,100 jobs could be cut. And China has launched an anti-dumping investigation into imports of U.S. sorghum. No new import duties have yet been announced, but the move is sparking fears of a trade war between the world's 2 largest economies. The move comes just weeks after the Trump administration slapped new tariffs on Chinese goods. China is the U.S.'s largest buyer of crops like sorghum and soybeans.
Okay, well, finally, we all know the Super Bowl is pretty big business. Too big, apparently, for some Americans with credit card debt.
That's right. It's no secret. It's an exceptionally expensive event with these so-called cheap seats averaging around $3,000 each. Well, personal finance website NerdWallet did the math. They figured that with travel expenses, a trip to the world's most watched American football game would cost around $11,500. If you put that on a credit card, paid just the monthly minimum, that trip would take 17 years to pay off. NerdWallet asked 2,000 U.S. consumers with credit card debt if they'd rather have an all-expenses-paid trip to the game or use the money to pay off their debt. 81% would skip the game and pay the card. That is
would
the smart bet.
Would they,
though? They say they would. That's true.
Good intentions.
You actually handed it to them.
But I actually say I'm absolutely baffled by the cost of the tickets. $3,000 for the cheapest.
I can't imagine.
Yes, love of the sport and all that. Brian Quinn there with the business news. Thanks indeed for that. Well,